Welcome back to Eurodollar University, everybody. My name is Emil Kalinowski. I'm joined by Jeff Snider, the head of global research for Alhambra Partners. And last episode was a big one. We talked about the Eurodollar futures inversion, the curve inverted, and how that's happened before and that it doesn't augur anything good for the global economy. We're going to check back in to see where the curve is today and check in on bond markets around the world and just do an update. Jeff will be reading off of your blog post from a few days ago, Eurodollar futures, there be landmines, December 4th, 2021, posted at Alhambra Investments. And Jeff, where do we start out? I suppose you start out by telling us that once the inversion happens, we shouldn't expect it to keep inverting, to keep doing something. There was just sort of a trigger, and then we'll check back in later. But you said that it turned into a running tally.
Yeah, usually, or at least by historical experience, in the initial first phases of inversion, there's just a little tiny couple basis points of upside down, and then it stays that way for quite some time. And honestly, it seems like, oh, it inverted, now what? After a couple months later, maybe it doesn't even look like it's moved all that much. In one sense, it kind of gets really boring from this point. We had the inversion, and then let's come back to it in a couple months and see what's happened. That's really what we were expecting, is that you get this little tiny inversion, and it kind of sticks around as little tiny for a while, and not really much interesting to add to it once it's happened.
And you could easily dismiss it. Then you can say, oh, it's just a basis point and it hasn't changed for months, so we can ignore it. But
yeah, who cares? It's just this little tiny thing. And it hasn't changed, so nothing else has changed.
It reminds me a little bit of economic growth and nonlinear growth. They're both upward sloping, these money curves, return on money and economic activity. It's supposed to be upward sloping. And so even if it is a tiny bit negative, that's way off trend. It's just, as we're humans and we have these monkey brains, it's easier for us to recognize the zero line, whether something's positive or negative. And that's what we latch onto. But we're missing maybe the exponential nature of money and economic activity, and that there should be an upward sloping trend, and falling off the trend is the key worry. And by day 3, which was a while ago, and you update us where we are now, you said, hey, there's still more activity. It's not done. This little dip of the toe into the water. Where's the Eurodollar curve now? Has it undressed completely? Is it skinny dipping in the pool?
It's changing. It's always distorting and twisting because markets are dynamic places and they change all the time. And it actually changed a little bit more last week than I was expecting. I figured a basis point, maybe 2 basis points at the most. But yet the inversion expanded both in depth as well as in reach. It got all the way up into I believe the June of 2024 contracts is where it started, reaching all the way into the 2026s. And at the most inverted depth, got up to about 4.5, 5 basis points during some of the days last week. It inverted in that little tiny place to start with, and then it immediately got quite a bit bigger. And then that's kind of where it's been over the last week or so, up to today, where the inversion is really kind of centered on the December 2024 contract. It's now 4.5 basis points. It reaches into maybe December of 2026 intraday. So you got quite a bit of inversion here, certainly more than I was expecting when I initially wrote that. But it's still, it's still not this huge, absolutely massive thing. And what you just said, Emil, is absolutely right. It's not the fact that, okay, it inverts and then it keeps inverting, keeps inverting, keeps inverting, it gets more and more and more. The fact that it's inverted, it even just a single or even a half basis point at all is what really should be concerning, because you're right. Every day that the curve is not upward sloping is a day that's been lost to whatever it is the curve is predicting. That's another day where the market is saying, well, things could have gone right, or whatever we were worried about, that's gone now. But that's not what we're seeing happening. We're seeing that every day that goes on, the market is getting more and more confident that whatever it's afraid of or whatever it's projecting out in the future, it's still there. And with the curve staying inverted all this time, what it's saying is that, yeah, not only is it still there, just by the mere fact of it sticking around through time, the market is saying we believe it's going to be there, and the probability of whatever it is that's going to go wrong rises every day that the curve doesn't straighten itself out and go back to an upward slope.
You just said whatever it is out there, and earlier you mentioned some specific dates, December 2024, if I remember correctly. And in another article, an essay that you wrote at Real Clear Markets on the 3rd of December titled An Inversion That Will Likely End the Inflation Narrative, you go back in time to the 2018 inversion and you ask the audience, the readers, did the Eurodollar futures curve predict the coronavirus infection global pandemic? Because when it inverted, it was predicting middle of 2020. Look out, guys, look right over there. And well, what did you tell the readership that about the
That's kind of what it looks
nature?
like, right? I mean, June of 2018, we got this inversion in the Eurodollar futures curve, and it was centered around the June 2020 contract. So if we take these contracts literally, it kind of sounds like the Eurodollar futures market was predicting something bad would happen in the middle of 2020, and this was 2018, so 2 years ahead of time, long before anybody heard of coronavirus or SARS or any, the anything that happened in Wuhan. The markets seem to be saying we know something's going to happen in June of 2020 if we take the curve literally. But we can't take these curves literally, and that's not really what happened. Instead, the market was saying in 2018, in the middle of 2018, that there was anxiety, there was deflationary forces, there were breakdowns in the monetary system, and the way the technical parts of the curve work. We talked about, the whites and the reds, the greens and the blues. The greens and that part of the curve is really where the market has more freedom, so to speak, to price in and hedge against, non-specific future worries. So June of 2020 just happened to be that part on the curve where in June of 2018, the market started to project its current worries, what it could see in the monetary system, collateral, all that, collateral scarcity and shortage, and project out into the future that, okay, at some point, this stuff is all going to add up into something bad. Not specifically June of 2020 or the middle of 2020. That's just where it happened to fall on the curve. And as we know, it was actually much closer in time than that, than it turned out to be, because we would see things start to really fall off within just a couple months in October and November of 2018. And of course, by 2019, the rate hikes were done. And by July of 2019, there was rate cuts. So the market wasn't predicting necessarily something would go wrong in 2020, just that there was some non-specific or not unpredictable or unknowable point which all of these bad things that were happening in June of 2020 would finally break the system down, create an inflection in the global economy as well as monetary policy, and lead to all sorts of bad outcomes, which is what happened.
And ladies and gentlemen, Jeff just a moment ago referred to the whites and the greens and the reds, and he was not referring to Christmas ties. It's a technical description of the Eurodollar contracts, groups of them, as we move forward through time. And you'll have to see the previous episode. But basically, the early ones, they're reacting to what the Federal Reserve is doing because it offers money-like alternatives. And so it has to reflect what the Federal Reserve is doing right now. But later on, down the curve, it's beginning to interpret economic activity, levels of inflation, what it believes the Federal Reserve will have to do because of the wider economy. So I guess bringing it forward to today, same principle applies, right, Jeff? The 2024, that's not it, right? We're not saying free and clear sailing until 2024. We're just saying that's technically when it's inverting, and maybe it'll invert more later. We'll see, or maybe it'll revert back to an upward sloping. But for now, it's just signaling a non-literal warning about the future.
Yeah, if we take the curve literally, then it sounds like the market is saying sometime in 2025, maybe something goes wrong. And okay, who cares, right? That's several years down the road. It's not something we should actually be concerned about. But as I said, we don't take these curves literally. The market is not literally pricing trouble in 2025. That just happens to be where the curve is breaking down into inversion. And again, it's not where it's inverted, but the fact that it's inverted at all is telling us that the market is perceiving some non-specific future period when things start to go wrong. And it's interpreting what's going on today and saying that today there's lots of stuff to be worried about. We don't have any specific concerns that, hey, tomorrow something's going to be wrong. but just balance of probabilities, all the stuff that is going wrong, the monetary system breaking down, collateral scarcity, same kind of stuff as we saw in 2018, rising dollar, yield curves, all that, everything.
Triple R.
The market is saying we have all of these issues today, balance of probabilities at some point in the future, these are going to add up to all the things that they added up to in 2019, which was an economy going the wrong way, monetary policy going the wrong way, inflation going the wrong way, everything going the wrong way. It's just that we're not quite there yet where the market is saying this is imminent, this is an immediate danger. For now, it's just that the probabilities are balancing in the wrong direction. They're just not overwhelmingly balanced in that direction.
So in the beginning of the article, you tell us all that, and you bring to our attention that the Eurodollar futures curve has started to invert a little bit more than you thought day after day. Since then, it's stabilized. And then you segue to another series of curves, yield curves, and that's the US Treasury bond market, as well as Japanese and German bonds. Can we talk about what we're seeing in the US Treasury market? I suppose we're seeing something similar, if somewhat behind Eurodollar futures, right? It's flattening. It's heading towards what might be an inversion, maybe. Or did I put words in your mouth? Flattening is the concern.
You go ahead. You can put words in my mouth all you want. That's fine. It's what we're saying is that, it's not just one thing or another. It's not just a little bit of inversion. It's not just literal inversion. This is just our starting point where we're seeing something significant happen in Eurodollar futures. And then we look at it and say, okay, we've got this inversion in Eurodollar futures. Is this an isolated signal? It's a big one anyway. But is this the only market signal that's sending off the same kind of, pessimism, skepticism, deflationary potential, that kind of thing? And of course, the answer is always no, because these markets usually work in tandem. And so there's all sorts of corroborative evidence all across the global bond market beyond just strictly Eurodollar futures, which is suggesting the same sort of rising deflationary non-growth potential. Something's not right today in the balance of probabilities. Moving forward, whatever's not right today is going to continue to be not right tomorrow. And eventually, if it goes long enough, then we start getting into some of the worst outcomes, some of the wrong types of outcomes that are not inflation, they're not economic growth, they're not prosperity around the rest of the world. In fact, it's the same stuff that we've seen repeatedly time and time again. And the timing matches up too. The Eurodollar futures curve, before it became inverted on December 1st, it really started to flatten out noticeably going back to late October. So late October shows up not just in Eurodollar futures flatness, but also in the US Treasury curve, for example. The nominal 10-year interest rate, the nominal 10-year Treasury yield, it peaked around in the most recent peak, I believe it was October 21st, which matches the Eurodollar futures curve perfectly. Ever since then, we've had more flattening in the US Treasury curve, as well as modestly lower nominal rates, especially at the longer end. Again, matching the Eurodollar futures curve, as well as all these other parts of the global bond market too.
And those two other parts that we're going to talk about right now, just briefly, is the German bonds 10-year and the Japanese government bonds, also the 10-year, and also October 26th and October 22nd. So
yeah, same time frame, late October, global bonds synchronized. Something changed where the market started saying, okay, we had a little bit of an upsurge and a backup in interest rates around the world in August, September, and October, which, as we talked about previously, there's some kind of seasonality there. That's interest rates usually rise. Maybe that's all that was. But even if it wasn't, maybe if the markets were, it was a sort of a relief sell-off that Delta COVID was behind us. Maybe things were going in the right direction. Then all of a sudden, late October hits and you get this globally synchronized skepticism. You get the Eurodollar futures curve. You get the dollar rising in exchange value. You get the US Treasury curve, nominal rates falling, JGB rates falling, that curve flattening, the German curve flattening, even the Greek curve flattening. You have global bond markets saying since October that there's more deflationary potential, more pessimism. And don't forget, during this particular almost a month and a half now, we've seen inflation indices accelerate wildly. In the United States, the CPI got up to the highest in 30 years, but yet we still see all of these curves around the world together in unison saying deflationary potential, not inflationary potential. And so you start, and again, going back to October, this is not Omicron. It's not the next wave of the coronavirus. It's something much deeper. Even if we don't know specifically what it is, I mean, we can guess there's something going on in the global marketplace. And it's really not just since October either, because we've been talking about this, Emil, since when? I mean, FedWire.
Yeah.
It goes all the way back to February and March. So we have, 9 solid months of growing skepticism. And as we've been talking about constantly, this series of escalating deflationary warnings, one after another, after another, after another. No matter what happens, it's just we constant stream of them, and they get bigger and bigger as we go.
It's not only those countries we mentioned, but just looking at it, the United Kingdom, Australia, Canada, France, Switzerland, their bond markets are also, since October, heading the wrong way, rising in price. You just mentioned escalating warnings. Final thing, it's not in your article, but you wrote about it recently. It's the triple R. That's just we've talked about it before, but out of China, another reduction in their required reserve ratio, which should sound like maybe it's stimulus, but really it just coincides, as we've seen historically, with just another warning. Hey, we're seeing something and we're concerned.
Yeah, it's another one of those misunderstood things where if you read a mainstream media article about the RRR, what it'll say is that, oh, good, the Chinese have flooded the Chinese system with more RMB because they've allowed banks to unlock some of their reserves and use them. But as we know, looking back, especially historically speaking, that's not what ends up happening. The Chinese cut the RRR in an attempt to offset what is already a deflationary wave, usually an external one that's being registered in China because of these Eurodollar problems, the external dollar problem that becomes an internal RMB problem that Chinese authorities try their best to offset with these RRR cuts. So what ends up happening is exactly what you just said, Emil. The RRR cuts are not actually stimulus. They're consistent with another escalating warning where the Chinese are saying things are going the wrong way. So, hey, look out, we're going to do this. We're going to do this RRR cuts again. So in my mind, in my analysis, and I think you probably agree with me, to put words in your mouth, Emil, is that I don't think there's any coincidence that we have December 1st, Eurodollar futures curve inverts, which is a big signal that things are going in the wrong direction. And then mere days later, this past Sunday night, the Chinese say second RRR cut of the year, which is another consistent warning that the global system, the global monetary system, financial system, as well as global economy are starting to really balance and tilt in the wrong direction.
Yeah, it's slowing down. And for anyone that goes skiing or snowboarding, the slower you go, if you hit any sort of little bump, you can get knocked over. I'm sure the global economy is the same way. Jeff, I'm going to segue to part B. Is there any final notes you wanted to share on this general topic before we go?
Just keep an eye on the Eurodollar futures curve, but don't be surprised if it gets really boring from here on for a little while. Maybe it doesn't move all that much, but as you said in the beginning, in a nonlinear world where everything is supposed to be one way, the amount of time it's not that way, the amount of time it's even a tiny bit inverted is a bad sign.
Well, what's not boring is the employment situation in the United States. That's what we're going to talk about in part 2. And for those of you who are outside of the United States, well, of course, employment corresponds very closely with consumption. And the United States is the biggest consumer in the world. So it's a big story for the whole world as to what's happening with the employment and the labor force in the United States. We're going to talk about it next.